Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today from Robert Sinn, known as Goldfinger on CEO.ca and CeoTechnican over on X/Twitter, and also publisher of Goldfinger Capital on YouTube and Substack. So definitely check out some of the links we put below this interview. It takes you over to some of Robert's pages. And Robert, always great to have you on the show, man, just to get an insight on how you're looking at the macro, the micro, the commodities, the resource stocks. You just got done with a whirlwind tour over to the West Coast and spoke at the Metals Investor Forum. I'd love to get any key takeaways that you talked about there or some of the themes that you heard from investors at the MIF.
Shad, thank you for having me. It's a pleasure. Yeah, I'm still in Vancouver today, but I'll be heading back to the East Coast later. Yeah, it's interesting. MIF in May is always a bit different. Vancouver's a beautiful place to be in May and June. So the weather is often really turning for the better at this time. The January MIF is always packed, full rooms. You can't even find a seat for some of the presentations. The May one is a little slower paced and laid back. Although I would say somebody counted the room during my presentation, and there were more than 150 people there. It was a pretty big room. So I was pleased with that turnout. But I would say generally the company booths were pretty slow. So, even though gold had, a $60 or $70 move on Thursday and Friday of last week, didn't really motivate investors to get out and come to a show this weekend. And, the average age is still up there. It's still up there. I didn't see any 20-year-olds there except for maybe some of the people with the mining companies. So that's just the reality of the mining sector still in 2024. Even though the metals are rallying and like copper's making a new high for the year this morning, investors aren't really paying that much attention to it, which is ironic. It's really ironic. And I think, in my mind, I take it as a good sign, because if every seat was full at MIF this weekend and all the booths were packed with investors wanting to know more, then that would be a sign that we're closer to the top. So I take it as there's still more meat on this bone.
Well, that's good, and it is a good contrarian signal, just that the metals are doing well and some of the companies haven't had liftoff, and we don't have that fever pitch euphoria that you do see in other sectors, and we will see in this sector again and have before. So, yeah, it's an interesting read on the ground. When you were talking to folks there, what were some of the key takeaways from the lecture you were giving?
Yeah, so I did a little, like in January, I did more about gold and copper macro. This one was different. This was a presentation focused on identifying patterns in the junior mining sector and patterns that could be signals that can help make you money. And I also talked about how volatile the sector is, just the crazy volatility of some of these stocks where, they can have 500% to 1,000% ranges every year, like year after year, where, you could have a stock go from 12 cents to 60 cents, back to 20 cents, back up to $1, back down to 30 cents. I mean, just crazy volatility. And I think most investors, from my experience, doing this for 21 years, most investors underestimate the volatility of the sector, and they bet too big. They position themselves too heavy. And then when it moves against them, they can't stomach it, and they end up making big mistakes. And so a lot of my presentation was about position sizing, going a little smaller, maybe 5% of your portfolio in one stock, not 50%, and just recognizing patterns, right? So when you read a news release from a company, is it important? Is it actually something worthwhile that's going to potentially change the value of the company, both on the bad side or the good side? And just showing some examples of that and how there's a lot of opportunities in the sector for those that are paying attention. I mean, really, you just need to pay attention sometimes and then take action on it, right? So I showed a few examples of those situations in the last year from my own portfolio, my own experience of being able to identify signal and then act on it and profit from it. Perhaps if I had more time, I would have talked more about taking losses and showed some examples of taking losses. I think people are more interested in gains and big winners, so I focused on that. But certainly taking losses is also a very important part of being a junior mining investor. And, when it's not working out, don't stay in the bad marriage. You got to just cut it loose sometimes and move on to the next one. And there's always the next one.
And that's such a great point. And there's a lot to dig into there, because I think that these are the kind of ideas that actually help investors the most, Robert. We can all talk about where we think the metals prices are going, or the general macro trends in the copper stocks or gold stocks, but it's really how you manage your own psychology as a trader, how you evaluate when it's time to cut bait and just admit to yourself that maybe it's a bad trade, or maybe you timed the trade wrong, and also looking at position sizing. Let's dig into the position sizing one first, just because I do think this is an interesting area. There are some people that, as you know, on Twitter or on chat board, will say they're all in on one stock, and that's a very risky strategy. Maybe talk about how you manage your portfolio, position size, how many positions do you have on at a time, that kind of thing.
Yeah, I think anytime somebody tells me they're all in on one stock, I immediately, look at them like they're full of shit, and I don't take them seriously anymore. Because either they really don't know what they're doing, or they're just lying to me, right? So either one is not good. Yeah, so one of the points I made was that my position sizing ranges, let's say, between 2% on the low end to 10% on the high end. So if I have high conviction, in an idea, and they're starting a drill program and I'm just gung-ho on the drill program, I might put 10% of my money into that one idea. But that would be a really high conviction. That's a big bet. Usually it's more in the 4 to 5% range, and sometimes it can be as small as 2%. Don't have more than 20 stocks in my portfolio at any given time. That's a rule I've learned. Every time I've gotten up to 25 or 28, it just hasn't worked out. And usually that in the past, that's been assigned to me. The sector is at a peak when I'm up to 28 stocks in my portfolio. That's a sign that I'm overweight, I'm overloaded, and I've got too many holdings. Usually when I'm down to 8 or 10, that's a sector bottom. That's a buying opportunity. It's weird how the human tendency is to buy more on the way up and at high prices, and sell on the way down and get fearful. But that's just how I've noticed it happens over the last couple decades. And yeah, I think a lot of investors make the mistake of just putting too much in one stock. And a lot of investors might actually buy more on the way down. And so when the stock is moving against them and they're losing more and more money, they keep buying it because they're unwilling to admit they were wrong, and they're unwilling to admit it's not working out. And I think that's another big mistake that I see guys making all the time. And the reality is sometimes cost averaging in works out when it's done for the right reasons. You get a little lucky, but often it doesn't work out, and it's just you're throwing good money after bad. And so that's something that I think is really important is that some investors, or investors period, especially in the junior mining sector, should regularly speak with management, should regularly stay updated on companies' progress. And if the signs are just not good, the body language is not good, just cut it and move on to the next one. At some point, you just have to admit it's not working out and cut your losses. And I think that's really important, because when you do that, it frees up your mental capital to find new ideas and stop staying, emotionally drained in something that's not working. And it also frees up your financial capital to take advantage of new ideas. I know some people will say, I can't sell because I would lose money. Well, I'd say you've already lost the money. When you're down 50% on it, that you bought it at 60 cents and now it's 30 cents, you can't sell it at 60 cents. You can only sell it at the market price. That's 30 cents. So you've already lost the money. So it's not like you're losing more by selling. You've already lost it, So yeah, I think that's a very important topic, and that's something I'll probably expand upon in the future.
Yeah, I think it's also somewhat nuanced, like you say. There are a few times where you would average down based on particular news information, or maybe a discussion with management where maybe the market reacted negatively to something that they didn't fully understand, or that the company didn't do a great job of messaging. And there are times where you're throwing good money after bad. And there's also times where you should buy on the way up and press your bets, even though it is rising. So maybe speak to that, the signals that you're looking for that would make you decide, okay, in this particular case, maybe I would average down, or in this particular case, maybe I will chase the price higher.
Yeah, that's kind of nuanced, but There's an example of a company, and some of your listeners might figure it out, where it was like 12 cents at the beginning of the year. It briefly traded above a dollar. And I think if you got in at 12 or 15 cents or, a much lower price and it went above a dollar, you have been foolish to not take half off the table on that big of a move. But now the price has retraced back to 60 cents. So if you had taken some money off the table on that big run, now you have an opportunity to reload again, even though it might be way above your first purchase at 12 cents or 15 cents still. If you actually understand the company's projects and the drill program that's currently underway, you might say, well, actually, this 60 cents is actually a really great opportunity. Even though it's so much higher than my first purchase, it's actually a good time to average up, right? And so there are rare circumstances where the drill results warrant averaging up, because actually the quality of the drill results are actually de-risking the asset and increasing the value of the company's project or projects. So it could warrant actually building a bigger position. But again, it's tricky because remember, this sector is so volatile. And even if a stock moves up 300 or 400% or whatever, it's still often going to retrace 50% or even 60% regularly, right? There's going to be this crazy volatility. And so one of the points I made is that smaller investors have the opportunity to trade around the volatility and really take advantage of the volatility. And that doesn't mean you should sell everything, but definitely trading around a core position where you might go up to 10 or 15% of your portfolio on a big move, and then you just trim it back to maybe 7 or 8%, take some profits off the table, and that frees up some cash for you to buy some other stocks or even wait for that one to come back down to a better entry price, and then you can add more.
Well, and another thing that we should probably address, and I think we were talking a little bit about this before we started the call today, is some of the seasonality in the sector news. So there's this period of time in the winter where a lot of Canadian projects are in freeze up, and even some U.S. projects at higher altitudes. Same thing with South American, kind of in the reverse seasonality. But when you look at some of these drill programs, they don't start until things thaw out. Other programs don't start until things freeze up. How are you playing the summer period here where a lot of the drill programs are about to get underway in the north?
Yeah, Shad, I think that's a very important point. The summer drill season starts usually at the end of May or early June, and then it will go for another 4 months, sometimes 5 months. And so I've got a lot of companies in my portfolio right now that just started drilling in the last month or are about to start to drill in the next month. And I think that oftentimes it's a great opportunity to buy right before the drill program starts if you like the company, if you really think highly of management, quality of the projects, the drill targets. Obviously, you got to do your DD, but once you've done all that, I think buying before the start of the drill program is often a great trading idea. And then how you manage the trade, that depends upon a multitude of factors, including the fact that you should be following the company news closely. I think you should have a monthly call with management. At the very least, you should email them and have a sort of conversation back and forth, get an update, get a feel for how they communicate, and get a sense of body language. Just simply put, get a feel for what a CEO sounds like when he's got good news and what a CEO sounds like when he's trying to put, lipstick on a pig, right? And that just comes from experience, but you've got to speak to management in the junior mining sector. This is a rare sector where CEOs are accessible to retail investors on a regular basis. In billion-dollar plus market cap companies, that just isn't the case. It's very hard to get a call with a CEO of a multi-billion-dollar company as a retail investor. But in this sector, because it is so starved for capital and engagement, these CEOs are willing to, and it's their job to actually talk to investors. So you should talk to them and learn from them, and it will help to better inform your investment choices.
Yeah, Robert, it's a great point. And we talk to management teams all the time, and often we'll do interviews where at the end of it, they'll say, hey, if anybody has any questions, give me a ring, and they mean it. or shoot me an email and they mean it, and they have an investor relations department that can help field out some basic questions, or often you can get to the COO or CEO of a company if you just are serious about investing and want to know more about the company. So I do encourage people to get more friendly with management teams in the sense of just understanding their communication and news flow. Let's give a couple scenarios here, though. Let's just say that it's a grassroots company. They're trying to make a discovery, and they do hit something that's interesting but not eye-popping. Do you press your bets a little bit more there? Do you just hold what you have? And then let's also do the opposite scenario where they come out with something that's only okay, it's mediocre. What do you do as far as trading around drill results as they come out?
Tricky question, because everything is in the details, right? So to me, I cannot make a generalization that would be accurate, but I will say that you should have your expectations for the results of the program. You should have an idea of what good results should look like. If the results are not to that level, more often than not, you should sell and not think twice about it. Sell first and ask questions later. And that's a generalization, so don't hold me to it. It's not going to work every time. You need to, and that's why doing the background work, doing the research, having the conversations with management will allow you to put the results in better context. Okay. But also that just understand as well, there will be a lot of CEOs in the sector that will put out subpar results. And when you talk to them, they will put as good a face as possible on it, and they will excuse it, and they will explain how now they have more data for next time, and now they know exactly where to drill. But when is next time going to happen, and how much money do they have to raise, between now and then, right? So you need to ask yourself those questions and ask them those questions, because more often than not, that whatever 6 to 12 month period until the next program starts, the share price is going to drop. Okay, if the results are not up to par, the share price is going to drop just as investors catch wind of it, and then they realize the company needs to raise money and yada, 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 right? And so that's just how it works. But you need to set your expectations and get a gauge of what the market expectations are for the results. And that's a question you can even ask the CEO or the VP of exploration. You can ask them, what good results for this program look like? And if they try to dance around the question, just say, what would the assay look like? I mean, on this hole, is it 50 meters of 1 gram gold? Is it 200 meters of 0.5% copper? What is a good result? And then you can make up your own mind.
Yeah, such good points is to have an expectation in mind ahead of time. And like our friend Rick Rule always says, the goal of this company on this particular campaign is to answer an unanswered question. Did they answer the unanswered question? And if they didn't, that may be a signal to get out of it. Or how much more money are you going to need to spend to be able to answer this question? Just good things to think about. Now let's think about more of an advanced explorer, though. They've had a couple drill seasons. They've put in a lot of holes. There's a known entity here. There's a deposit forming. There's maybe some resources on it, some earlier stage resources. Would you like to see that company keep pressing the bet and building more resources? Or when I talk to companies this year, Robert, almost all of them are saying, we're not going to do that because the market doesn't reward it. We're going to go try to make a discovery somewhere else on our property. Do you like that idea of letting the deposit sleep for a while and to go look for new discoveries?
Really, I think, Shad, it's all about probabilities. So if their work on the ground in proving up new targets is showing them something that they believe is really high probability or high enough probability that if they hit, it would really move the needle, then by all means, test those targets. But if they are going off to drill big regional targets and get away from the core deposit that they've drilled out for the last 5 years, that could also be a sign that core deposit is just not economic enough. So that could be you have to put it into context. I think building ounces is great, but at some point, if you've got enough ounces built, you need to say, okay, well, how do we prove up this deposit? Can we get some of these ounces into a higher category of certainty? Can we prove out a higher grade core area of the deposit so it improves the payback period for the initial capex? There's a lot of important questions, like that. But I love exploration. I love new discoveries. So if a company can really prove to me a compelling target, I want them to test it.
Sounds good. And it is a nuanced answer. So it's tough to answer these for all companies because there are situation dependent answers. But I do find some companies don't really have a great strategy. Their strategy is, hey, we just want to get rewarded for something. And since discovery drilling is getting more rewards, we're going to go do that. But they maybe don't have the compelling targets to back it up. So it all takes talking to management and knowing what the game plan is and how that ties into the overall thesis. Let's talk about companies that have even gotten a little more advanced though, Robert, and they've got that resource. Maybe they've got some economic studies, and now they're shopping it for the takeover. We've seen a wave of take unders, the occasional takeover. What's your thoughts on M&A in the sector? Are we going to see more of it with some of these more advanced projects?
I mean, I think we have to, and I think I've been saying that for the last 3 years, but I think we have to. And we are starting to see some of it, including, obviously, there's a very big transaction that's been talked about the last couple of weeks with the number one mining company in the world trying to buy one of its smaller peers. And so I think consolidation is happening across the mining industry, including the gold mining sector. And I think we will continue to see more accretive deals take place when it actually makes some sense to the bottom line to put two companies together. Then I think it will happen. And certainly with share prices starting to move up, companies have a little more currency to work with to make deals work. I think that when share prices are depressed and everybody's currency is cheap, it doesn't make as much sense. It's harder to do deals. So as the market improves, as valuations improve, I think we'll continue to see more and more deals.
Well, and to your point, if a larger company's got that currency because their share price has gone up and they can use that to make an acquisition, for a lot of junior investors that are in the smaller company being taken over, that's their exit strategy they've been waiting for. But what do you think about some of these juniors that are getting together and doing a merger of equals to mass up? So they're trying to do a 1 + 1 = 3 scenario, like, hey, you're a junior, I'm a junior, we both got resources. What if we combine these into a larger company? Is that just making their problems more compounded because now they have two projects to fund, or is that a good strategy?
Well, it cuts one set of corporate overhead. So for some of these companies, that could be saving as much as $2 million a year, or maybe even in some cases $3 million, right? So you're saving quite a bit of corporate overhead by doing something like that. And I think generally with like an optionality play, like a really big deposit, but kind of a marginal grade with a big capex bill, like an optionality, right? They need the metal to go up 50% to make it work. Then it does make some sense to put two optionality plays into one, because you're cutting all that corporate overhead that you don't really need. And if they're not really doing a lot of exploration, they're not doing big drill programs, then they're just waiting for the market to come to them. It does make sense to sort of cut your cash burn down as small as possible and size up your ounces as big as possible, so that, you know, when that time comes, you are more attractive to that bigger company. But I mean, at the small exploration level, it really doesn't make any sense. The only times it really makes sense is if there's an overlap in terms of location of projects. So you're in the same region of the world where, you know, you can have one office, you can have one exploration team, the projects are all in the same area, then that often can make sense. But a lot of companies are, you know, reluctant to do that because it's their projects. They don't want to give it up to someone else, and they don't want to lose their salary. So there's a bit of friction in making those kinds of deals.
Yeah, and sometimes there's a bit of friction in the two families coming together. The two families of investors often shoot arrows at one another's projects instead of understanding that maybe they are better together. So it is, again, a nuanced answer here. But when you're looking at these companies for optionality, they got ounces in the ground, or if they're copper, they got pounds in the ground, and they want to see higher prices. Well, people have been saying that for a while. There are these good optionality projects. Well, if you look at most projects now, they should be economic at $470 copper and at $2,300 gold. Almost every project is somewhat economic on paper. So how do you separate the winners from the losers in optionality for gold or copper stocks when they've got those resources, but metals prices show they're economic right now?
I mean, I think it comes down to permitting timelines, right? So the faster permitting timelines, those companies are going to have an advantage of how permittable is the deposit. And then CapEx. I mean, That is a big hurdle. I hear it time and time again from other investors, from corporate. Financing a $1 billion capex is way more practical and way more realistic than a $4 or $5 billion capex. There's not many companies in the world that could pull off a $4 billion capex build. There's dozens that can do $1 billion. Okay, there's maybe a handful that can do 4 or 5 billion. So that matters a lot. I mean, is it a lower capex? Is it faster build? Is it easily permittable? Those are way more valuable. Those are way more valuable, and they're way more likely to react to moves in the metal prices than one like a pebble, up there in Alaska. That I don't even know what the capex for that is, but I'm just guessing it's $10 billion, right? It's a massive amount, and the permitting roadblocks for that are basically impossible, right? So that's an optionality project in a way, but it's really not, because they can't get the permits and they can't build it. So if it's less than $1 billion and you have an 18-month permitting timeline with a high probability of getting the permits, then you have a really good optionality play.
All right. And then between copper and gold, copper typically have those higher capex like you're discussing, but they also are longer life mines, typically 20, 30 years, even more than that sometimes. Gold projects tend to be more in the 8 to 10, maybe 12-year range when they get started, and then they hope to find and keep growing the deposit over time. But their capexes are smaller, but then again, not as big of a life of mine. How do you contrast, when you're looking at these economic studies, the gold stocks versus the copper stocks?
Yeah, that's a tricky one. The way I've sort of learned it in the last year is that the big mining companies want long life mines. And so if the life of mine is only 8 years, regardless of what the metal is, it's just not going to be that interesting to them. So you need to be able to demonstrate probably a minimum of 10-year, life of mine with a lot of exploration potential to bring that up to 20 years. And unless it's in that category, it's not going to be a takeover target from a Big 10 mining company. And then the difference between gold and silver and copper here is very interesting because, while gold could certainly trade up to $3,000 over the next couple of years, that's still only like a 20 to 30% move from current levels. There's a possibility that copper could double in the next couple of years. I mean, that's a bold statement, and I'm not necessarily betting my life on that, but it's a possibility. It could go from $4.50 to $8 or $9, right? And if such a move should take place, it would make so many more copper deposits much more economic than at $4 or $4.50 a pound. So for me, I am much more interested right now in copper projects that have optionality. So those big porphyries that might only have an average grade of 0.3%, those are way more interesting to me than a gold deposit of a couple million ounces that has the grade of only 0.5 grams per ton.
Would you feel the same way about silver versus gold then? Because it's more likely that on a percentage basis that silver could get closer to doubling than gold could in a next 2-year window. Would you feel the same way that maybe silver stocks have that optionality factor just from the price increase on a percentage basis?
I would feel that same way, but then I would also in the next breath say, Shad, show me some silver primary projects in the world that actually have that kind of scale for a major. And I bet you'd be hard pressed to even name 5 of them.
Because so many are polymetallic, having the
polymetallic,
copper.
Yeah, they're not silver primary, right? And so if they're mostly lead zinc, the fundamental driver of the valuation of the deposit is not the silver price, it's the lead zinc prices. So silver primary projects are rare. And then even more rare, silver primary projects that have more than 100 million ounces of silver.
Absolutely. I can think of a few, but I'm not going to say their names out loud, just out of respect for those that have and those that have not. One more question, though, just that makes me think about is polymetallic deposits in general. For example, if people are excited about nickel as a contrarian bet, there's hardly any pure nickel plays. They're almost always nickel, platinum, palladium, copper, cobalt, all kinds of stuff mixed in. There's other projects that have really interesting copper grades, but mixed with a bevy of other metals. And the same thing, like you say, in the silver space, so many of them have 3, 4, 5 metals in the mix. Do you think investors, especially retail investors, but even institutional investors, have a hard time valuing polymetallic projects because they kind of have an identity crisis?
Yeah, there's an identity crisis, with Eloro. I think that's the first one that pops into my head. Is they have like 7 different metals, and there's also questions about the, metallurgy. So anytime you have so many metals in the deposit, you're going to have multiple concentrates. It's not going to just be one concentrate. It's going to be 2 or maybe 3 different concentrates, and each metal has different recoveries, and that's complicated. That's a very complicated science problem, way above my pay grade to figure out, and above most people's pay grades, quite frankly. So there's a lot of people that shouldn't be making opinions on those kinds of deposits that do. It's just tricky. It's tricky. And yeah, I mean, if you have tin, silver, lead, zinc, copper, gold, bismuth, and they're all kind of at comparable quantities of the deposit or fractions of the deposit, it's like there's an identity crisis, right? And so that's actually that can actually prove to be a negative. I think you're exactly right. And that's also why good metallurgy is so valuable. So when you have like a silver primary deposit with recoveries of 95%, even if it's only 60 million ounces, it could actually be of interest to a bigger company because the recoveries are so good and silver primary deposits are so rare to find today. But still, 60 million ounces is not going to move the needle for Pan American or something, right? So that makes it challenging, right? It's really rare to find those. And so when you find those big deposits with good metallurgy without, like an identity crisis, they're way more valuable.
All right, and final Jeopardy here, Robert. What are you most excited about as far as, let's say, the summer season here, the next 3 to 4 months? What areas of the market, what commodity, what kind of stocks are you just most excited about?
Oh, that's a tricky question because I'm excited about quite a few things right now. I'm just going to stick with what got me here, the horse that brought me here, and that is just the copper porphyry plays. So whether it's copper gold or copper moly silver, porphyry deposits, and trying to find big porphyry deposits in the US and Canada, I think that's the name of the game right now and for the foreseeable future. I think that's what the majors are really interested in. And I think if one of these companies can really make a new discovery, they will have a big splash and it will sort of give a tailwind to all of them, a much needed tailwind that the juniors need. Okay. And so I'm following a number of companies that I own currently that have drill programs either underway or about to commence shortly. And I'm very excited about a number of those. And then just from the less speculative to more long-term, just keep stacking metal, gold, silver. If you have the ability to stack copper, just keep stacking metal, and there's lots of different ways to express that view. There's lots of different vehicles, but also just physical. I think when we have big down days in gold, I think it's a buying opportunity. And the higher highs and the higher lows in the chart tell me I'm right until proven otherwise. So I think just keep it simple. There's definitely some very speculative ways you can express a view on higher copper and gold prices. That would be in juniors that are exploring. And there's a much lower risk way, and that's just simply buying physical metal. So those are my simple themes.
Well, let's wrap it up there. Appreciate you sharing those themes with us. And yes, focused on the porphyry projects for the copper and the gold, looking for those discoveries, or stacking the metals, stacking the gold, stacking the silver, or you can get an Olympic-sized pool and throw a bunch of pennies in there and stack that copper. So definitely some good thoughts. And if people want to follow along with Robert's thoughts more regularly, he's got a lot of different ways to reach out, a lot of different content, a lot of different channels. We'll put a couple links to those down below so you can follow along with Robert's work. And as always, man, looking forward to our next conversation.
Thank you very much.